Markets trade close to record highs, perhaps driven more by liquidity and positioning than fundamentals. Today I'm joined by Kathryn Rooney Vera, Managing Director and Chief Market Strategist at StoneX, to explore what's behind recent moves, the role of fiscal policy, the impact of AI, and what signals to be watching heading into next year. Great to see you again, Kathryn.
Thank you so much, Fiona.
So you've said the market's strength is coming more from liquidity and positioning than fundamentals. What does that tell you about the nature of this rally?
Well, it tells me that investors have been chasing the market because what happened was at the beginning of the year, everyone was overweight the market. And then when Liberation Day happened and the Trump trade war, everyone got really spooked and went underweight the market. So everyone has been playing catch up since then. So since April, money has been chasing the market and a lot of liquidity. And that's what you're seeing, I think, evidenced in the buying of the dip. So anytime there's a dip, guys are buying it. So active managers are still doing that. There's still a lot of money out there, and I think that that flows are chasing, valuations and opportunities in the market.
And you've also warned that changes in money market balances and treasury issuance could create liquidity strains. How might that kind of shift play out?
So I talked about how we have a lot of liquidity right now, and what I'm referring to is cash on the sidelines. Money market funds are at record highs, and money market funds, that's cash. Guys are still earning a decent rate because the Fed is still at pretty high interest rates. But these money market funds are the largest buyers of T-bills, and T-bills are the main mechanism of funding the United States' massive fiscal deficit. Remember, we have almost a 7% fiscal deficit, which is quite frankly unheard of, Fiona, outside of times of war or recession or some sort of crisis. We're far from all of that, and we still have a 7% fiscal deficit. So what happens is when the Fed cuts rates, these cash yields fall because the yield drops and money leaves. And this can happen very quickly. We saw this happen in 2018, and it caused yields to surge and markets to correct. So, if the Treasury lengthens its supply, so Treasury goes from T-bills to longer duration Treasuries to finance the deficits, and money market fund demand drops simultaneously, that timing mismatch can jolt funding even when aggregate cash looks abundant. This is exactly what happened in 2018, and this is what I'm warning could recur. So you can get a brief spike, Fiona, in front end rates, you can get tighter financing conditions, and a mechanical risk off before flows recalibrate.
So fiscal policy seems to be setting the tone more than monetary policy right now. And what are the implications of that change?
Well, the implications are huge. And as I mentioned before, the large deficits are requiring the United States, which the Treasury is the deepest, most liquid market in the world, to have to spend more money on interest payments than on major areas of spending, such as defense. And that's what's happening right now. So large deficits and rising interest costs mean more duration to absorb. So with the Fed and with foreign central banks owning proportionally smaller shares, they're still buying, but when you look at the numbers, they own proportionally less than historically in terms of their ownership of treasuries, and you have price sensitive private balance sheets and owners owning more of those treasury yields. That raises the term premium, and that keeps the long end yields higher than usual. And the front end can decline, but the back end stays long. So even if the U.S. growth softens, you can see the back end still move higher, and that's what I think occurs because of these fiscal deficits.
And AI remains in a heavy investment phase. How do you view its roles in shaping market dynamics from here?
This reminds me, Fiona, of an arms race, but it's an AI race. So AI is this era's largest corporate capex expenditure. It's front loaded. Corporations are investing in data centers, servers, power. So a lot of this is like a big capex expenditure without clear profits as yet. So that means near term margin pressure, for capacity builders, so companies that are investing in this, while cash returns lag that spend. But remember that that's also tied to power bottlenecks, which is getting very little attention, in my opinion.
And with valuations stretched and leadership narrow, what broader themes or signals will you be watching as we move into next year?
The most important thing is earnings. So valuations are stretched, but if earnings continue to surprise to the upside, they can get even better. So I think that the S&P 500 is at about 20 times forward earnings. Yes, it's 2 standard deviations above where it historically trades. So that shows that it's rich and expensive, and leadership remains very narrow. So, the Mag 7 still lead the majority of this upside in the S&P. So I think everything comes down to earnings revisions. What we're watching is money market balances, T-bill demand, and refunding for any supply issues. I'm looking at 5 and 10-year break evens. If they drift above 2.6%, that could cap the Fed's capacity or limit the Fed's capacity to cut rates. So that's going to be an important market mover. And then, like I talked about, the bottlenecks that we see in grid capacity and AI capacity. I think revisions in terms of earnings are something to look at, especially when we talk about the large cap quality names. And I think the path of the dollar with the famous dollar smile is something that's important to look at for shock risks.
Well, thank you very much for your analysis once again. Great to catch up with you, Kathryn.
My pleasure. Thanks, Fiona.
For more videos like this, please do like and subscribe.